Welcome to Byte-Sized Tech, where we blend casual conversations with insightful discussions on the latest in technology and gadgets.
Great to be here.
All right, let's dive into what's been happening in the tech market lately. You've got a bunch of reports and analyses here, and the big picture seems to be a real tug of war.
Definitely. A mix between short-term jitters and some, well, pretty strong long-term beliefs, especially around things like AI.
Exactly. So let's try to make sense of what it all means for, people watching the market.
That's right. We've seen this interesting dynamic play out recently. After some downward pressure on tech valuations, we've witnessed what's being called a relief rally.
A relief rally, yeah.
But what's fascinating is where the interest is concentrated. It's not just a general rush back into tech stocks.
No, it feels more targeted.
Exactly. The sources point to very specific areas like artificial intelligence and maybe smaller companies seeing significant investor activity and strong trading volumes.
Right.
It's as if those previous dips, say 10 to 20%, are now being viewed as, well, attractive entry points.
Especially for investors looking longer term.
Precisely. They're really taking a fine-toothed comb to the market, looking for particular opportunities.
It's like after the initial market wobble, folks are saying, okay, prices are a bit more reasonable now. Where are the real deals? And it sounds like chip stocks are one area getting a lot of attention.
Yeah, definitely hearing that. The feeling is that their valuations have corrected to a point where they look interesting again.
Makes sense.
And when you look at the long-term conviction around artificial intelligence, it's remarkable.
Still incredibly strong.
Absolutely. Even with the short-term market ups and downs, the underlying belief in AI's transformative potential remains incredibly strong across the board in these reports.
So the recent price drops just make it easier to jump in.
Kind of. The recent adjustments in valuations, after perhaps some earlier exuberance, seem to have made it a more compelling investment for many who understand its long-term trajectory. It's almost seen as too significant a trend to ignore,
Yeah.
even if there are some bumps along the way.
Right. Okay. Now, one strategy that keeps popping up in our sources is this idea of focusing on U.S.-based tech companies, kind of a way to mitigate geopolitical risks.
Mm-hmm.
On the surface, it sounds straightforward, keep your investments closer to home.
Yeah.
But, how feasible is that really in today's tech world? It's so interconnected.
That's a critical question. I mean, when you consider the global nature of the tech industry, our sources indicate that over 60% of the broader tech sector's revenue actually originates from overseas.
Over 60%. Wow.
Yeah, and supply chains are also incredibly intricate and globally integrated. So while the notion of solely investing in U.S. tech to avoid geopolitical headwinds is appealing in theory,
The reality is messier.
the practical reality is much more complex, yeah.
So you can't just draw a circle around the U.S. and say, only tech companies inside this line. But the idea, as I understand it from the material, is to identify companies that primarily operate within the United States.
Pretty much.
Companies that mostly hire, build, and sell their products domestically. That way you still get exposure to the tech sector while maybe limiting the direct impact of global trade stuff or supply chain issues.
Precisely. This strategy involves being selective, identifying companies with a strong domestic focus. Think about maybe e-commerce platforms that primarily serve the U.S. market.
Okay. Or maybe AI firms focused here.
Or AI-focused firms that concentrate their research, development, and sales within the country. These types of companies could offer you exposure to tech's growth potential while providing, a relative buffer against international volatility.
And it seems this approach might also involve being a bit more cautious about some of the really big guys, the Mag 7.
Well, yeah.
And maybe even some of the communication sector giants, simply because their operations and revenue streams are so heavily international.
That's a logical conclusion based on the data. Given their extensive global footprint, a U.S.-centric investment strategy aimed at reducing geopolitical risk would likely lead to underweighting some of those mega-cap tech companies and communication sector players.
Right, the ones with significant international integration.
Yeah. It's about making targeted choices based on your risk tolerance and investment goals.
This whole discussion really brings us to the balance between that long-term conviction we talked about and the short-term uncertainties we're all facing. It sounds like for those of you with a 5 to 10-year outlook, the focus is really on getting granular.
Mm-hmm. Targeted exposure.
Targeted exposure in high-growth areas like artificial intelligence, even if there's some near-term market noise.
Exactly. Despite the current volatility, the fundamental drivers for long-term growth in transformative technologies like AI infrastructure remain robust, according to our sources. Investors with that longer time horizon are often more willing to look beyond the immediate market fluctuation.
They focus on the themes with strong future potential.
Right. It requires a certain degree of resilience, maybe, to stay invested during turbulent times, reminding yourself that the core reasons for long-term optimism haven't necessarily vanished.
And it helps to remember that many of these tech companies have incredibly strong cash flow. They're actively reinvesting, right? Building out those massive data centers needed for AI.
That's huge.
That suggests a continued long-term commitment, regardless of the week-to-week market swings.
That's a crucial point. The strong financial health of many tech companies and their ongoing investments in crucial infrastructure, like data centers driven by AI's potential and their robust cash generation, it further reinforces the long-term conviction in the sector's growth prospects.
Okay, now let's touch on the overall market mood. I mean, I don't think anyone holding stocks feels completely comfortable right now,
Not really, no.
especially with the tariff talk hanging in the air. But it's interesting how the market can sometimes surprise you and bounce back, seemingly even when the news isn't all that great.
That's a very insightful observation. Market reactions are rarely straightforward, are they? We've even seen instances highlighted in some of our sources where a semiconductor-focused ETF has actually risen despite the looming threat of increased tariffs.
Really? That seems counterintuitive.
It does. It suggests that some investors might be strategically positioning themselves for a potential market rebound, perhaps thinking the worst is priced in or something else.
And it seems like the sentiment among everyday investors, the retail crowd, is actually quite bearish right now.
Very bearish. Some reports say even more so than during major downturns like the COVID pandemic or the 2009 financial crisis.
Wow. That kind of widespread negativity often makes you wonder if we're actually closer to a bottom than it feels, you know?
Indeed. That level of pronounced bearish sentiment among retail investors can often be a contrarian indicator. It might suggest the market is oversold and due for a bounce.
The bounce doesn't mean the absolute bottom, right?
Yeah. Exactly. It's important for you to remember that while a bounce might be likely under these conditions, it doesn't automatically mean we've reached the absolute low point. Caution and a long-term perspective remain advisable.
Okay. This leads to an interesting idea that's been circulating. Maybe the recent market pressures aren't so much a broad tech problem. Maybe it's more of a Mag 7 problem.
Ah, yes. The idea relates to their huge spending.
Right. The thought is that some of these tech giants have been on a massive capital expenditure spree, investing heavily in things like servers, and there are concerns about how quickly that equipment might become obsolete.
What's particularly noteworthy here, and what our sources emphasize, is the evolving role of these big tech companies. There's a growing concern that their significant capital expenditure on infrastructure, particularly servers, might have shorter than anticipated depreciation schedules.
Because tech moves so fast. Like Blackwell, Rubin.
Exactly. Due to the rapid pace of technological innovation, this is significant because these companies are increasingly becoming major customers of compute power, like NVIDIA's, rather than primarily being the producers of that technology themselves.
So they're buying the shovels now, not just selling them.
In a way, yes. This shift in their economic role has implications for their profitability and future investment strategies.
Okay, so it's a flip. They're not just building the tools, they're the biggest ones using them. Now, one company that seems to be in a unique position amidst all this is NVIDIA.
Ah, NVIDIA.
They're almost seen as being in a sweet spot right now.
NVIDIA really stands out in the current environment. Our analysis suggests they are a direct beneficiary of all that increased capital expenditure on compute power.
Because everyone needs their chips for AI.
Precisely. Their specialized chips are essential for the advancements in AI. Furthermore, their relatively limited exposure to the Chinese market and the fact that semiconductors have so far been exempt from broader tariffs.
That helps too.
It positions them as potentially one of the more resilient stocks within the tech sector today. Some are even calling it, maybe, the safest stock in the market today.
Bold claim, but you see the logic. Okay, shifting gears slightly. The back and forth between Elon Musk and Peter Navarro regarding tariffs caught my eye. Musk didn't hold back, did he?
No, he didn't. Calling Navarro a moron in response to the idea that Tesla is just a car assembler.
Yeah. It sounds like Musk is really trying to emphasize the amount of U.S.-made technology in Tesla vehicles, pushing back hard on that.
Yes, Tesla has been actively highlighting its domestic manufacturing and technological innovation, especially against the backdrop of increasing tariff concerns, while acknowledging that tariffs could have some impact.
He's arguing they're better positioned.
He's clearly arguing that Tesla's high percentage of U.S.-sourced components offers them a greater degree of insulation compared to other automakers. And he's been quite vocal in his opposition to tariffs generally, advocating for free trade.
And there's this other angle in some of our sources suggesting that maybe Musk needs to consider stepping away from some of his more politically charged roles,
To protect the Tesla brand, yeah.
particularly in Europe and the U.S.,
Yeah.
where his public stances on various issues, including tariffs, might be alienating some consumers.
There's certainly a perspective emerging that Tesla's brand has become increasingly intertwined with political narratives, and Musk's continued involvement in government-related matters could potentially be contributing to brand damage in key markets.
But the long game for Tesla is still.
Despite these immediate challenges, the long-term strategic vision for Tesla often still centers on advancements in autonomous driving technology and robotics. That seems unchanged.
Right. Finally, it seems like all this uncertainty swirling around, particularly the tariff situation, might be having a cooling effect on the IPO market.
Seems likely.
We saw reports of companies like StubHub potentially delaying their plans to go public.
Yeah, the prevailing economic uncertainty, which is undoubtedly amplified by concerns about future trade policies and tariffs, can create a less favorable environment for initial public offerings.
Makes sense. Companies get hesitant.
They may become more hesitant to enter the public markets during periods of high volatility and uncertainty, leading to postponements or even cancellations of planned IPOs as they assess the landscape.
So, okay, to bring it all together for this deep dive, what we're seeing in our sources is a tech sector navigating a really complex environment.
Yeah.
We've got the potential for trade tensions, shifting investor sentiment.
But also some clear areas of strong interest and long-term conviction, particularly in AI and certain segments of the chip market.
It really makes you think about how these big macroeconomic and technological forces are going to shape the future of the industry and how individual companies will adapt. And, what are the real long-term implications of focusing on domestic tech when the industry is just so global? That's maybe something for you, our listeners, to consider.
Absolutely. The interplay between rapid technological innovation and evolving global economic policies is creating a dynamic and, well, at times unpredictable landscape. Understanding these underlying forces and their potential impact will be crucial as you navigate the investment world.
That's a wrap on this bite-sized look at the ever-evolving tech world. Join us next time for another deep dive into what's shaping our future.
Sounds good.
Thanks for tuning in to Byte-Sized Tech. If you enjoyed the episode, like, comment, share, and subscribe for more fun tech discussions.